welcome to the AJ Bell Money and Markets podcast. I'm Danni Hewson, and joining me this week is Tom Sieber. Hi, Tom.
Hi, Danny, and hello, everybody. Yeah, we've got loads to cover this week, including a spot for AJ Bell shares and markets writer Martin Gamble to discuss some of the big updates on corporate earnings and interest rates from the US, including news about a new member of the $4 trillion club. And we're going to be discussing results from the banks and next, new records for the FTSE 100 and must-pay deal at Tesla.
It's never a money and markets podcast without an Elon Musk section.
I know.
If that wasn't enough, we'll also be looking at one of the top performers on the FTSE 100 in 2025, a name many listeners may not have heard of, and also discussing signs of easing shop price inflation.
But first of all, let's get Martin Gamble on to discuss the big US earnings news and the latest update on interest rates from the Federal Reserve.
Martin, thanks so much. There is so much to cover off when it comes to US markets and what happened overnight as we record this, because due to the magic of podcasting, and yes, if you are watching this on YouTube, I have put the same jumper back on again just to make editing a bit easier. But we're going to talk about a whole load of things which happened overnight. Let's start with the latest decision on interest rates from the Federal Reserve, Martin.
Indeed, yes. Well, that was nailed on. The markets had something like a 99% probability they would cut rates, which they did by 25 basis points. So no surprise there. But interest rates, while the Fed was talking in the press conference afterwards, started drifting up because Powell made it fairly clear, very clear, that there was a lot of discussion within the committee, and another cut in December was not nailed on and not a foregone conclusion. And interestingly, this decision, we also had two dissenters. We had Mirren, who's one of Trump's appointees, so people expected him to push for a bigger cut. So he wanted to see a 50 basis point cut, half a point cut. But we also had another committee member who wanted to leave rates where they were, which was, I don't think that's happened for like the last 6 years. We had a dissent in two directions. So that was a big takeaway, and markets didn't like it. The S&P sort of sold off as he was having this discussion with the press, being asked about whether AI was a bubble, being asked about whether the stock market was in a bubble. He kind of battered away those questions very neatly. But the other takeaway was that he announced the ending of QT. So he's going to shrink. He's been shrinking the balance sheet for the last few years, and that's going to stop on December the 1st, which means the balance sheet will remain as it is. And that's another big sort of news item that came from yesterday's decision.
And we also, talking about AI, because that's been, a dominant factor in how markets have been performing, we did have 3 of the so-called Magnificent 7 updating last night. What were the key takeaways there?
Yeah, so it's roughly almost $10 trillion of market cap was reporting yesterday, and the market reaction was mixed. They were all beats. Well, Meta shares fell around 7% in the aftermarket, and there was a disappointment that they booked something like a $16 billion non-cash one-off tax charge related to the big beautiful bill. So that was a bit of a surprise. So they missed earnings, but if you exclude that, they actually beat the estimates on the revenue line and on the profit line. But what the market didn't like was they were talking about increased accelerated spending on AI. So they raised, in fact, all 3 companies, so Google, the Alphabet owner Google, and Microsoft, all raised their estimates for spending on AI. And I think that's become a concern, and that's probably contributed to the fall in the shares in the aftermarket. And the same thing happened with Microsoft. It was a good beat. They saw like a 49% increase in their cloud services Azure business, which was better than expected. But again, the market didn't like the fact they're going to be spending billions and billions and billions over the next few years on data centers and AI. It just doesn't, it wants to see some evidence that it's going to make a return before they'll give the companies the benefit. And remember, going into these numbers last night, all of these stocks were up between 1/3 and 40-odd%. So there's a lot of positivity going into these numbers. So they had to do something special to get a good reaction. Now, Google did get a nice reaction. The shares are up about 7% in the pre-market, because I think the spending they're doing is a lower proportion of their cash that they generate. So the market's kind of making that connection between what they're saying, what they're doing, but almost also how much of their cash flow are they committing to these ventures. So that's kind of, I think, the main messages from three of the Mag 7. So pretty mixed.
I was watching markets ahead of them reporting, and as you say, I mean, it was great guns yesterday. And one of the big AI, proponents is Nvidia, and that hit an incredible $5 trillion market cap yesterday. Why?
Yeah, I mean, it's up around 50% year to date. It just keeps going and going and going. Well, there was a big conference, wasn't there, I think, in Washington. CEO Jensen Yang sort of announced some deals there. They announced like a $250 billion deal with the government or the Department for Energy for the US. And it's just all this excitement around chips and data centers. I think that's what it's about. And in fact, interestingly, OpenAI this week, finally, they've a private company. They were basically a foundation, charitable, not-for-profit company, but they've decided to split into two. The foundation will still own the profit company, or control it. But Microsoft have got a 27% stake in the for-profit side of the business, which is valued at something like $135 billion, which implies a market value for OpenAI of around $500 billion. And yesterday, Reuters ran a story saying that OpenAI are eyeing up an IPO valued at $1 trillion. I think it would be the largest IPO in history. And obviously, Microsoft are in the box seat, so they've got a nice stake in that business. So that should be helpful. But yeah, there's been, I lost count of how many deals that have been announced in the last 2 weeks on AI, data centers. It's getting crazy.
A lot of it is cyclical. I know a lot of sort of companies within companies giving money to other companies, and then it's all sort of going around in a circle, which has made people a little bit nervous. But one thing that also happened, I told you there was a lot of news, was Donald Trump met with the Chinese Premier Xi Jinping and came out and said that on a scale of 1 to 10, the success of the meeting was a 12. And, the trade deal was done. And I think there's been a lot of nerves about that. There are a lot of caveats to that. And one of them seems to be that there was no talk about these BlackRock chips, these chips that Nvidia make that China wants.
Yes, I mean, that was a bit disappointing, I guess. So we'll see how the share prices open later. But yeah, I think there was some expectation that would be part of the deal, because that's the US government's got a stake in that, because anything they sell to China, the US government, I think, will take a 25% share. But at the same time, China have said they don't want their companies to buy these NVIDIA Blackwell chips because they can do without them. They can develop their own AI. And in fact, they can do it more efficiently. So there's still this sort of battle going on for supremacy in the AI market. And I think, as you say, it might have a negative impact later when the share price is open, but we'll see.
Note my Freudian slip there. I'm not sure BlackRock would be keen to be, they might be
did I
keen
say
to be
BlackRock?
associated with the chip.
Yeah.
No, you said Blackwell. You said it right. I said it wrong. So there we go.
I'm glad you picked that up. I didn't pick that up.
Martin, thank you so much for talking to us.
My pleasure.
As I said at the beginning, you're now going to hear the rest of the podcast with myself and Tom Sieber. We didn't know, as we recorded the podcast that you're about to hear, any of what you have just heard. So bear with us, but here we go.
There's not just been lots of news in the US, there's also been plenty going on in the UK market too.
Yeah, we've also had fresh records for the FTSE 100, as well as announcements from most of the big banks. And we're going to start there. So what have they been saying, Tom?
Yeah, so after we had a bit of a wobble earlier this month, linked to some signs of stress in the private credit market in the US. So this is where an institution that isn't a bank comes up with a kind of tailored borrowing arrangement for a business, just very kind of broad brushstrokes on that. But there's been concern in that area, and that has affected the whole banking sector. But really, the the updates that came out from the UK banks on the third quarter were pretty reassuring. So we did see Lloyds take a hit from the motor finance scandal, but investors had been very well prepared for that in advance. So there wasn't any kind of a shock there. And the other kind of, I guess, negative or kind of surprise news was from HSBC, and they made a provision linked to the Bernie Madoff scandal. I don't know if you remember him. I mean, that we're going back,
that's going back
20
some
years.
way.
It is going back some way. It's to do with how HSBC provided custodian and kind of administrative services to funds who invested with Madoff, basically. So, and this was a case that was being heard in Luxembourg, and basically a court ruling has gone against HSBC there. So there was that provision. But putting those two kind of slightly exceptional things to one side, Lloyds, NatWest, HSBC, Barclays, all produced pretty good underlying numbers. The underlying performance of the businesses was pretty strong. And I think that provided a kind of a bit of reassurance, like I said, to the market. And that was reflected in, some positive share price reactions to those updates. And I think as well as some other, fairly strong corporate updates and some optimism about a trade deal between the US and China, as you mentioned, or as we touched on earlier, the FTSE 100 has reached this kind of fresh record level. I mean, it's obviously just a number in kind of, it's a bit abstract. It doesn't necessarily mean anything per se, but like the fact that the FTSE 100 is getting close to 10,000 does feel quite significant to me. I think partly because earlier in my career, it really seemed to be stuck in this kind of rough range between 6,000 and 7,000. And to see it kind of actually break out a little bit feels quite telling. And I think also it's nice to have a positive conversation about the UK markets for a change.
It is nice. And I think I've lost count of the number of times that I've been able to write. And the FTSE 100 closed at a fresh record high today. It's been quite astonishing, the moves that it's made. But while we're talking about the FTSE 100, I wanted to ask you about this because there's a little known constituent of the index which keeps nudging up to the top of the FTSE 100 leaderboard. So can you reveal the name? Because it's been absolutely tearing it up in 2025. And just give us a bit more about it.
Yeah, absolutely. Yeah. So this is a company called Airtel Africa. I won't keep you in suspense any longer. And it's obviously not as high profile as a lot of other companies on the FTSE 100, but its performance has genuinely been pretty kind of blockbuster. And it has some recent results out which have kind of helped to extend that positive run. So you can kind of get a picture of what it does from the name. It's a mobile phone and internet carrier in Africa. So it entered the African kind of mobile and broadband market back in 2010. And sort of in the intervening period, it's established some leading positions in several countries on the continent. So over that time, it has grown quite rapidly. And as you can imagine, I guess, to sort of use the language, these are less mature markets than the UK or whatever. There isn't the number of people who have access to mobile and broadband and stuff. It is less. And it's been investing quite heavily in mobile infrastructure, in modernizing the kind of broadband networks in several of these markets. And that's enabling it then to provide kind of digital services like, mobile payments to customers. And I think you're kind of starting to see some of the benefits of that investment coming through in terms of the growth. So, it's an interesting story. It is obviously kind of a slightly different focus from a lot of other companies on the FTSE 100, but it's certainly been one that's been resonating with investors. I think it's doubled more or less over the course of 2025. So it is clearly striking a chord with at least some investors.
Yeah, it's been fascinating to see the FTSE 100 move the way it has. It would be great if we could be saying the same thing about the FTSE 250, but clearly that's more domestically focused.
Yes.
that there's plenty going on in the UK economy, which is making some businesses, certainly some consumers, feeling a little less confident, shall we say. And certainly one of those things came from Rachel Reeves, who has said today, as we record this Wednesday lunchtime, that yes, she is expecting a productivity downgrade from the Office for Budget Responsibility. That report, the final report's due to land on her desk on Friday. We won't get to see it until Budget Day, the 26th of November. But of course, it's leaked absolutely everywhere. So the figure has been put on it. We're expecting a downgrade of 0.3%. And that doesn't sound like a huge amount until the IFS put it in context for us. So they reckon that for every 0.1% that the OBR downgrades the productivity forecast for the UK, it will cost the government £7 billion. So that effectively increases that black hole that Rachel Reeves was already having to contend with by about £21 billion. So this is going to be a big budget, make no mistake about it. And she's come out fighting. You may have seen some of the comments. She wrote a piece in The Guardian saying that Britain can defy these gloomy forecasts, but also said dreams don't come free and not easy. So speculation, of course, that there will be tax hikes. I mean, how many times have we discussed those government commitments, the manifesto promises on tax? A lot, right?
A hell of a lot, yeah. I think that kind of idea that they wouldn't put taxes up on working people, however you want to define that, that's, I don't know, it feels like the soundbite for this Labour government, really, doesn't it, in a way?
It does, but looking at the numbers and the fact that Rachel Reeves has said that she doesn't want to have to keep coming back for more, that she wants to have more of a buffer in place, more headroom to deal with any, economic issues. I mean, she has had a hard run of it. Let's be honest. The fact that the OBR are doing this shift now, this downgrade now, means that she is the one having to deal with this black hole. It could have been done any time. It could have been done before the Conservative government gave us that lovely national insurance cut before the last election. But no, it's being done now. So in some ways you could think Rachel Reeves might be feeling a bit hard done by, but actually she's also pointed to the fact that we have had a few green shoots in the UK economy. The latest PMI numbers look pretty good. The latest retail numbers look pretty good. Government borrowing costs have come down. There is expectation now the Bank of England is likely to cut rates at least once more time this year. I was just taking a look at probability, market expectation, and there's now a 40% chance of a cut in November. I mean, a few weeks ago, we were saying there is absolutely no way there's going to be an interest rate cut in November because inflation's just too high. It is high, but it didn't peak as high as many people had thought. So, yeah, I mean, I think this is going to be a fascinating budget. I said about a week or so ago, I said it's going to be dry, it's going to be difficult, and it's going to be divisive. And I stand by that because I think that there's going to be an awful lot of small print that we're going to have to pore over. I think a lot of people are going to really feel the impact of this budget. And I think that, a lot of people will be pointing at all kinds of different places, things that she could have done, because there's an awful lot of speculation around at the moment. I mean, it's tricky, isn't it?
Oh, it's really tricky. Yeah. I mean, you touched on inflation there and perhaps there being, a little bit of an improving picture on that front. And we've had kind of another development in that regard, haven't we, with news about kind of shop price inflation. So could you tell us a little bit more about that? And then also, I suppose, in the retail sector, we've had some results from Next. So it might be worth covering that off at the same time.
Yeah, retail bellwether Next. Always fascinating to cover their results. But you're right, we did have an update. So this is the BRRC and market researchers NIQ, and they take a look at their shop price monitor. We get it once a month, and they look at shop price inflation. And there has been some better news because overall shop price inflation has slowed to 1%. Which is great. And overall food inflation fell to 3.7%, down from September's 4.2%. But fresh food is causing a lot of pain. So if you're someone that likes to cook from scratch, that's now 4.3%. That's how much more it's costing to go and buy your fruit and veg, your meat in stores than it did this time last year. There was one thing that I spotted, which made me very happy. Are you a big Halloween fan? Do you go trick-or-treating your kids at least?
No, I mean, the kids are very excited. And because I live up in Glasgow, they do it. I mean, this is a bit of a kind of Scottish trait, not to upset our Scottish listeners, but they have their kind of idiosyncrasies. And Halloween, the kids go guising, not trick-or-treating. So my kids will be out guising on Friday, which means they have to have a joke or a song or some kind of party piece that they can do at the door. So not trick or treat. But yes, they're very excited about it.
But still, chocolate will be involved, I'm guessing.
Chocolate and sweets will definitely be involved. You can more or less guarantee that.
Well, this is good then, because chocolate and confectionery, their prices come down because we've seen some easing global sugar prices. So, that's an excuse to spend a bit more on sweets and treats for Halloween. Not that we need any excuse. Exactly. But, one retailer that's had a real treat, but seems to have had almost continuous good results is Next. And they are incredible when it comes to managing market expectation. They just seem to understand where their sales are going to come in. They downplay them a little bit. And then when they present them to markets, they go, hey, we've actually done better than we thought that they were going to do. And this is textbook, because they've done exactly this again. They've said, hey, we're upgrading our profit guidance. We're optimistic. We've seen sales grow. We're expecting full price sales to go more. But hey, sales are slowing down a bit. So, just keep an eye, just keep a weather eye out on what's going on. It's fascinating. But they are a very clever retailer. Look, we saw sales slowing a bit because Marks and Spencer, they got a huge bump from the fact that Marks and Spencer had been hit by that cyber attack and grabbed quite a chunk of its sales. That sort of eased away, but still doing incredibly well. And what was interesting is that UK sales were up 5.4% over the quarter. Again, online, doing really quite well. And the bit that really got me was overseas sales up 38.8%. So Next has never been one to sit on its laurels. It's always looking for the next big thing, whether it be bringing in different kind of brands which can use its store estate to, bring things back, or use its distribution hubs to try and make the journey quicker for customers. And now it's looking outside of the UK for growth. And it just seems like a really smart move by Next to always take things slowly. They don't want to go too far too fast. But yeah, I mean, it's a good set of results from Next again in what could have been a very challenging time. Now, for all money and markets listeners, this is the time when we need the Elon Musk klaxon. I'm very sad that we haven't got one yet, but it's
come on. It's overdue, isn't it, at this point?
It is overdue. There's a big story which has been brewing, for weeks, maybe more. It feels like over a year, and that's about his pay deal. It's coming to a head now, Tom. What's been happening and what are the latest developments?
Yeah, that's right, Danny. So one thing we had this week was the chair of Tesla, who's a woman called Robin Denholm. And I guess a lot of people might not know that name. I mean, I think when it comes to Tesla, Musk does seem to dominate a bit. So she's been speaking to the Financial Times and saying, look, if you don't agree this $1 trillion pay package, so yeah, it genuinely is $1 trillion, ahead of a vote, which is coming on the 6th of November, then he might be off. And she has characterized it as there's no Elon Mark II, so they can't find somebody else who could do the same job that Elon did. And that's against the backdrop of a situation where you've got these shareholder kind of advisory specialists. So there's a number of companies that fulfill this role, but two of them, Glass Lewis and ISS, have essentially told shareholders they should be rejecting the deal. And Musk, in typically restrained fashion, has dubbed them corporate terrorists in response. But I think there's a few things to say, for balance. I mean, you might question why you would be rewarding Elon Musk with an unprecedented, this would be the biggest corporate pay package in history, when Tesla's share price has certainly been nothing to write home about this year. And, even perhaps looking back a little bit further than that, there was some recent research also out this week, actually, which suggested he might have cost Tesla 1 million or more sales of Tesla vehicles because of his political activities in 2025. On the flip side, it is fair to say that the headline number doesn't tell the whole story. So if he was to achieve that $1 trillion figure, he's got to hit what are some very genuinely very, very demanding objectives. The amount of earnings that Tesla would have to get to is, 1 million miles away, really, from where they are at the moment. And really, if he wants to get this 1 trillion, he's going to have to turn Tesla from what it is today, which, most of its money, obviously, or that it generates, comes from selling electric vehicles. His vision of it being kind of this much broader AI and technology business, that's going to have to come to fruition if he's going to get anywhere close to the objectives that have been set. So, I guess that is something for shareholders to weigh. I mean, people have different views on it, and obviously the headline number is astonishing. And even, if he didn't hit those kind of the most demanding objectives, I'm sure he would still be getting an enormous amount of money. But I think it is worth sort of saying all of that and giving the kind of context for it, because that context is important.
I think something which really jumped out for me was the fact that they've been banging on for years about an affordable EV, about bringing new models to market. And yet when they finally delivered it, it was, something of a whimper. It wasn't anything new. And it just sort of cemented the fact that in his mind, and possibly in the mind of a lot of people at Tesla, they're moving on from just being this pure play EV company. And you're absolutely right. I mean, if he wants to get that pay packet, he's going to have to work for it.
Yeah, no question about that at all. Now, as we record this episode, Amazon is actually just about to release its quarterly earnings, but we had some news ahead of that this week about, what could be quite a significant round of job cuts. And perhaps unsurprisingly, this is another story with links to AI. So, Danny, could you explain a bit more about this story?
Yeah, I mean, it's confirmed that it's planning to cut 14,000 roles from its global corporate workforce. I mean, that's a significant amount. It's not as many as the 30,000 which had first been reported, but it's where those roles are, why they're being cut, and how they're able to be cut that's really interesting. And AI plays a big part in all of that. So we had Beth Galetti, who's the senior vice president at Amazon, who wrote to staff, that the move's going to make the company even stronger, and that by shifting resources, they're able to invest in their biggest bets and what matters most to customers' current and future needs. So I think a lot of people will have been looking at how Amazon's been performing, and we'll find out more later in the week, and wondering why these cuts needed to be made when it's been doing so well. But they're spending a huge amount on AI. And we know that with all this talk about a potential AI bubble, a lot of investors have been a bit nervous about how much money is being spent on AI. They want companies to demonstrate that they are taking a good long look at the amount of money that's being spent. They're looking at the bottom line. They're looking at opportunities to cut costs. And what they've said is that they can cut costs by cutting jobs because they're integrating AI into the Amazon workforce. It's created a lot of really interesting reporting on jobs and AI and what is the future of the workplace. But it is a significant number of jobs going, bearing in mind that a couple of years ago, they went through a similar, bigger round of cuts. But we also, just to sort of flesh out the fact that there are an awful lot of job cuts coming at the moment. And we had an update from UPS, United Postal Service, saying that over the first 9 months of 2025, it had actually cut 48,000 positions. We knew it was on this huge cost-cutting round. We knew that it's been challenged by the fact that we've seen, obviously, tariffs. We've seen a lot of supply chain issues. We've seen de minimis loophole closed in the United States. So a lot of those parcels that were coming from Shein and Temu, the numbers have slowed somewhat. We know that it's been looking to really bolster its share price. So it doesn't come as a huge surprise, but it is more than the number that they had initially said would go. And it's operational workforce, day-to-day logistics that it's taken the knife to there. And of course, whenever we get these kind of cuts, you take a look at how investors are reacting to it, and its shares did jump significantly on the day.
That's really interesting. Yeah, like you said, I think, we've seen emerging the impact AI is likely to have on workforces, what it could, it's still not clear where we're going to get to, but certainly the initial sort of start to that whole process is beginning to come through, isn't it? So to wrap things up on today's show, we're going to have a bit of a change of direction and have a look at gold, which, despite some recent volatility, it's still been one of the best performing assets in 2025. And Danny, I know you've been speaking to the Royal Mint's Stuart O'Reilly about what's been driving the precious metal to record highs, where the price might go next, whether, it's almost too late now for people who are interested in getting involved, and the different options when it comes to investing in gold. So let's hear more now.
Thanks so much for talking to us, Stuart. I suppose, the last time we spoke, it was because gold had been breaking records. This year, it's just kept on breaking records. What's behind that?
I think it's largely to do with uncertainty, and you're right. It's been going on for quite a while. Last year, we had over 40 record-breaking gold prices, and we've had over 40 this year so far. That's both in pounds and in dollars. And I think it is related to that uncertainty. I mean, the IMF recently said about uncertainty, buckle up, it's here to stay. I think that's really what's driving demand for gold as a bit of a safe haven. You had the Bank of England, the IMF, and a few others talk about the potential of an AI stock bubble. And they kind of caveated it a little bit, but I think that's kind of created a bit of nervousness around the stock market. The obvious one probably is tariffs with the US. I think every time we think we know what's happening, the White House comes out with another announcement. Recently, we've just had escalating kind of tariff situation with US and Canada. But the big one probably is US and China, which seems to be escalating. Actually, the White House probably not just tariffs, but a lot of the things that the White House is doing, because it's such major changes in terms of just the way that they operate, the way that America is kind of realigning itself on the world stage. That's creating the uncertainty. And some of it's to do with politicization, actually, as well, of the Federal Reserve, of the Bureau of Labor Statistics. I think there's concerns among investors that both of those institutions that investors rely on so much in terms of the data that comes out of them to make an investment decision, that those potentially are becoming a bit more politicized, and maybe the data therefore isn't quite as reliable or as impartial as it might have been previously. And I think that's kind of leading to a bit of speculation about, where could we be headed, and do I need to buy a safe haven like gold?
I mean, you mentioned a safe haven. The dollar has traditionally been considered a safe haven, but the value of the dollar has fallen significantly. And a lot of investors, a lot of central banks are choosing to find other safe havens, gold and silver being among them.
Yeah, absolutely. Central bank buying has been really high now for the past 3 or so years. And that doesn't really show any signs of slowing down. The banks are buying a kind of widespread, so it's not just one part of the world or countries that all have a similar kind of economic outlook. It is really widespread, and I think some of that is related to the buying of bonds. Anyway, it is related to fears about government debt. So there's concerns in Japan. I mean, the Japanese Prime Minister said that the economic situation in Japan was worse than Greece's during the sovereign debt crisis. Since has resigned, and now there's a new Japanese Prime Minister who has pledged to kind of spend a lot of money. France as well has had a series of problems since their election last year. They've had 3 prime ministers resign over trying to get a budget passed in Parliament. The prime ministers want to kind of cut spending, and Parliament's perhaps not letting that happen. And then the US as well. The US is spending huge amounts of money. They had Doge, which came in and tried to kind of cut the size of the state. And then on the other hand, they had this one big, beautiful bill, which kind of pledged huge amounts of spending and tax cuts at the same time. So the concern about debt and what that means for bonds in the future is also driving gold demand, because they're often seen as almost competing assets for a safe haven. Gold obviously doesn't pay a yield. And in an environment when interest rates are coming down, it reduces the opportunity cost of holding gold over holding bonds. And I think that is seeing some investors switch to gold, particularly given the momentum it's had over the past 18 or so months.
When you put it like that, looking back over the year, no wonder I've been busy. I mentioned silver at the beginning there, because we've also seen silver hit fresh record highs, and that is often interlinked with gold. But just in terms of silver, aside from it being safe haven, it's also used in a lot of industrial capacities, including building data centers.
Yeah, absolutely right. Silver is mainly an industrial metal in terms of the use of silver and demand for silver. And the price of silver has kind of traditionally tended to follow gold. So gold is up in pound terms 49%, dollar terms 59% so far this year. Silver is actually up 60% in pounds and 70% in dollars this year. So has risen kind of more sharply than gold has. And you're right to point out that it's used in industry. It's used in AI data centers, for example, and that's because it's a really good conductor of electricity. Gold is also a great conductor of electricity, and in your phone and your laptop, you'll have gold that kind of holds the printed circuit boards together. And the reason we don't use silver in your laptop or your phone is because silver corrodes in certain environments, in humidity, for example. But in an environment that's controlled, where you can control the temperature and the humidity, like an AI data center, silver is cheaper and it's more conductive for electricity. So it's the obvious choice. And as we kind of progress down this route of using AI for kind of more and more purposes, we might see that silver demand increase. It is probably at the moment a fairly small part of the market in terms of being used for AI data centers. Photovoltaics is the largest kind of single segment of the market, and that's things like solar panels. Silver's used very heavily there. But 60% of demand is industrial, and only really about 20% of demand is investment demand.
So we've spoken about why gold and silver are in demand. There have been quite a lot of stories about a fear of missing out, investors rushing to jump on the bandwagon. For people listening, if they haven't done it yet, have they missed the boat?
I think there were probably investors saying that this time last year and probably this time the year before as well. It's always really hard to tell. Most analysts at the moment in the market seem to be pretty bullish on precious metals. And we did recently see a bit of a step back in the price. We saw the largest single day drop in the gold price since 2013. If you remember all the kind of wranglings of 2013, that was the kind of after effects of the financial crisis and everything that kind of fell out of that. So it was a significant drop, but actually we're only back to the price where we were 2 weeks ago. So gold is still over $4,000 an ounce, which was what it hit 2 weeks prior. So it's a significant step back, but the analysts tend to be pretty bullish on it at the moment. So potentially, potentially there's still legs. The fundamentals of gold and of silver actually do look fairly strong. The demand is still there. That uncertainty is still there. Central banks seem to keep buying. And that would suggest that demand is only going to rise. Silver as well, the market has been in deficit for a number of years now in terms of demand outstripping supply. So you would expect that to have some sort of impact on the price. But it's one of those things, isn't it? It's who knows? But people tend to see gold as a bit of a long-term asset. So people aren't tending to buy gold today and sell it next week. They'll hold it, particularly if it's physical form, in coins or bars, for example. They'll hold it for 5, 10, 20 years, or maybe even kind of pass it on through generations. And over that time frame, gold tends to perform pretty well. And the other kind of strategy that we're seeing increasingly being employed by investors at the Royal Mint is this kind of dollar cost averaging. So people buying little and often, so that they're kind of flattening out the peaks and troughs of the gold price over time, and then just gradually accumulating and hoping that the price continues to rise and therefore make a return when they come to sell.
Okay, so let's strip out the should they, what's going to happen, and let's just talk about logistics of actually investing in gold. How can people do that?
There's lots of different ways. So some people like to buy gold mining stocks, for example, because obviously a gold mining company is the performance of that company is probably correlated broadly to the gold price, because that's what they're producing, but also is impacted by lots of other things about how that company is run, the kind of grade of the mines and the amount of gold they're able to get out of those mines. So a purer play would be something like a gold ETF, gold ETC on the stock exchange. So you can buy in the same way that you buy stocks and shares, but you buy gold essentially that's held either in a bank, or the Royal Mint's product is held at the Royal Mint. Or you can buy bars and coins physically and have them either shipped to you, or you can store them in the Royal Mint's vault. And the advantage, I think, of buying coins, and the reason that at the Royal Mint we tend to see coin demand be much heavier than bar demand, is because in the UK, if you're buying a legal tender coin, it's capital gains tax exempt. So lots of customers of ours, for example, will be buying gold sovereigns or gold Britannias, because when they come to sell those coins, they're capital gains tax exempt. So they do not have to pay tax on the profits that they make. They would have to if they bought a bar.
I wanted just to ask one more question, because it was notable in this morning's retail sales figures as we record this on the 24th of October, that a lot of people are now buying gold jewelry. Gold jewelry was quite out of fashion for a while, but it seems the high gold price has made people's ears prick up.
Yeah, definitely. I think it's gold in the news will always lead to people either actually having a look in their drawers and their jewelry boxes to see which bits of gold do I not want anymore, which, they've got a broken necklace, a broken bracelet that actually I could sell and capitalize on the gold price. And also, it does drive people to have a look at, maybe I should buy gold, and I don't know what form I want to buy it in, but at least I can wear the jewelry. So that's a little extra. And if you think of other parts of the world, they tend to buy gold jewelry based on the gold price, the spot price. It's not so much in the West. If you go into a jewelry shop in London or in Cardiff or wherever, there'll be a fixed price, and you can probably come back tomorrow and it'll be the same price. In large parts of Asia, the price will be fluctuating. So the jeweler behind the desk will have an earpiece in, and they'll be kind of communicating live with somebody who's monitoring the gold price, and they'll be selling that gold based on the weight of the gold plus whatever manufacturing charge they need to charge. And it means that large parts of Asian markets are very aware of the gold price. So when the gold price spikes in those markets, they think, oh, well, maybe it's a bit expensive, maybe I'll wait and see if the price comes off a bit. I think what we saw earlier this year was that patience kind of ran out, and they came back into the market anyway because they didn't think it was going to fall. And we've certainly seen a rise in jewelry sales in silver and platinum as well in Asian markets, partly because of gold just being, seen as more expensive as it was. If you walked into a jewelry store last year and this year, you'll have noticed a big increase in the price. So that's perhaps pushing people towards silver.
Stuart, it's been fascinating talking to you. Thank you so much for your time.
Thank you.
Really interesting stuff, Danny, and plenty to think about off the back of that conversation. Right, before we go, just one final thing, a little look at personal finance. We've had quite a significant development in the UK property sector as the Renters' Rights Bill becomes law. So, Danny, could you explain what that might mean for tenants and for landlords as well?
Yeah, I know a lot of people are really interested in investing in property, and there have been a lot of changes over the past couple of years which may have put people off, although we have also seen sky-high rents, and the increase in rent, the increase in demand for rental properties, which of course then helped boost up the rental market and the amount that people could charge, that has all been taken a long, hard look at in this Renters' Rights Bill, which was finally approved on Monday. We will get more details of how and when each of the changes are going to come into force as the next sort of few months go on. But it's a huge number of people that rent. I was quite surprised. I don't know why I was quite surprised, but more than 11 million people are going to be impacted by this. They're renting in the private sector. And I'm just going to do sort of a bit of a whistle stop through some of the big changes, bearing in mind this impacts England only. So obviously it's very different in Scotland already. But properties are now going to be rented on a periodic, or what's called a rolling basis, rather than those fixed contracts. So at the moment it's sort of 12, 24, sometimes longer periods of time, but it just gives tenants a bit more certainty. So if they want to stay in a property, they can do so. If they want to leave, they just need to give 2 months' notice rather than being tied in, which the government says, look, if you're in a property which is inappropriate, you turn up and things aren't working, then you don't have to stay for a full year. Landlords, if you're talking about rent increases, they can do that, but they're going to have to give 2 months' notice, and they can only increase the rent to what's been called the market rate. And if a tenant thinks it's excessive, they can challenge the landlord at a first-tier tribunal, which is a type of civil court. So it just means that that's going to prevent bidding wars, so they can't be asked to pay more than the advertised price, because we have seen rents jumping up quite significantly. I think the ONS was saying that private rents increased by 5.5%, average to 1,354 in the 12 months to September 2025. For landlords, it means that you're not going to be able to sell or move into a property in the first 12 months after a tenancy begins. After that, they've got to give 4 months' notice. Now, there are certain circumstances where landlords can evict tenants, because obviously there are some tenants who are problem tenants. So if they damage the property, they commit antisocial behavior, they fall significantly behind in the rent. Now, that's more than 3 months now. So it is significantly behind. Then a landlord can then give them notice. If they don't then move out within 4 months, then they have to go to court to see whether or not the property can be repossessed. Now, there's been a lot of comment about this, designed obviously to give renters more rights, more security. That there are a whole host of other things, including whether or not you have to accept pets. If you are a landlord, do take a look. There's a whole load of stuff on the government website about this. But it was interesting that the National Residential Landlords Association said that it is going to work with the government, but it does mean that the way that prospective tenants are screened, it is going to be, they're going to do a lot more of a careful job on it, because they need to make sure that they are mitigating any potential risks. So although it does give more security, it could become more difficult to actually get a tenancy in the first place.
Yeah,
So,
and potentially more expensive, I guess.
well, they've got to go with the market rate. But
I mean, more in terms of, if you have got to sort of go through that screening process, the kind of administrative costs of that, etc. I guess that might be a factor for people.
Yeah, certainly if landlords decide to pass that on, I don't know if they're able to, but it might be something that landlords have to deal with themselves. A lot of this detail we still haven't got, so we're going to find out more of the sort of dotting of the I's and the crossing of the T's and the small prints as time goes on. But if you are a landlord, do get in touch with us, podcast@ajbell.co.uk. That's our email. We'd love to hear from you. But that wraps up this week's Money and Markets episode. Thanks as ever for listening, and a special thank you to our very own Martin Gamble and Stuart O'Reilly from the Royal Mint, and also thanks to you, Tom, for jumping in and sharing hosting duties with me. I know that you'll be back in due course, I'm sure. Next week, Dan Coates was going to be back with more updates on the markets and the latest in personal finance.
And don't forget, if you enjoy the show, make sure you follow or subscribe wherever you get your podcasts so you don't miss an episode.
This podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. The value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.